Good afternoon, and thank you for joining us for the Healthcare Sector Spotlight. My name is Andrew Friedman. I'm an analyst on the healthcare team here at Hedgeye, and I'm joined today with Healthcare Sector Head Tom Tobin. We're going to have a brief presentation, then open up to Q&A, and if you have any questions, submit those on the QA box on the Hedgeye website, and we'll try to get to them at the end of the call. And that said, Tom, it's all you.
All right, thanks, Andrew. I think what I'm going to try to do, since we've got a fairly compressed period of time, is encourage you guys, anybody who's watching, to hit us with questions, qa@hedgeye.com. I'm really interested in the types of questions you guys have out there, but just to start from our, take a huge step back in terms of our investment process, what we've tried to do here at Hedgeye over the last several years is build out an idea generation process, a machine, essentially, using a full complement of data, both that's freely available through a lot of government data sets and other unstructured data that we put together. Really put those together with company-specific values that you can pull out of transcripts on the earnings calls, filings, press releases, et cetera. And then we go out to a community of experts, either that we recruit on our own or find expertise where we need it, basically to test our data stories that we build up through those two processes and then bring it around. And what that results in across the board, when we look at a full complement of healthcare types of companies, about 120 we consider fair game in our list, is we end up with something called the position monitor, where we've got our best longs and best shorts and things that we're stocking that really aren't right on a timing basis or a catalyst basis. So right now we've got just a handful of longs and things that we're looking at, and mostly short at this point. For a whole host of reasons that really start with the macro perspective and then we drill down to the individual company basis. One of the things that we're most concerned about right now is really I think we're in the early parts of 2017 in a post-Affordable Care Act world, or ACA 2.0 as we're calling it. And one of the things that really hasn't occurred, at least on a substantial way, is the give up of performance across the XLV and other healthcare indices. So when we look at the S&P 500 versus the XLV, we've got some modest underperformance over the last several time periods, including on a one-year basis, and that was really a give up around third quarter earnings. We've bounced back substantially off the 3Q lows with the Trump rally, as people are calling it. But as you can see on a 3 and 5 year basis, we still have a long way to go. So when we think about multiples, when we think about growth rates, those two things go together. And what we're not really seeing is that getting reflected in the price performance here on an extended time period. So as we look for our catalysts on a macro side to flow through on the company side, we're again leaning heavily short. Where we think we have a really hard time finding long ideas is sort of a synopsis of our big bold-faced ideas here. It essentially comes down to the top on the list there is to short the U.S. medical consumer. And for most Americans, we all pretty much know that copays and deductibles have been going up. From a provider standpoint, what that means also is that the margin profitability on the commercially insured, or the people who get their insurance through a non-group or a employer-sponsored insurance, that margin's highest. Whereas the margin on Medicaid and Medicare is pretty low across the board. So if we think about the U.S. medical consumer is growing at a steady 2% rate, 2.5%, what we're really going to see is a mix shift towards Medicare and away from commercial pay. And then within that context, the comp out on the Affordable Care Act, again, that pushed a ton of new people with insurance into the marketplace 14 and 15 and 16. And we're now on the back end of that slide with a lot of downside from here. On the regulatory environment, we all know about repeal and replace now has become repair. We think that's a secondary item, but going to create a lot of uncertainty and a lot of investment problems across the capital cycle. And then, we've heard a lot lately from management teams who have really been downplaying the ACA. Again, this is where we look for commentary around our data analysis. We hear it from the physicians and the other providers we talk to that, yeah, there's been a slowdown and it's getting harder sledding on the volume side going forward, but the management team seem to be downplaying it. Again, relative growth, relative multiples kind of track together. And then over the last couple of years, we've seen a ton of debt go on the balance sheets and a lot of M&A occur. And then CapEx, has really been buoyed, people who sell beds and stretchers, people who sell hospital equipment, or any other kind of large ticket items we think is setting up, not quite yet, but on the CapEx side to be short anything that's highly levered to that. And then what we're looking for on the long side is cost of care. So in this environment, you want to be long. People who can provide cost of care at a lower price. Anybody who can take share in even a stagnant market like an Athena. And then product cycles that are individual or idiosyncratic to a particular name. Here's our chart on the insured population. This is something that isn't wildly obvious away from this work that we did, where we basically created an index on a month-to-month basis that measures the Medicare population and then looks back at the employer-sponsored population. That's based off of non-farm payrolls and private payrolls, which comes out monthly. But what you can really see here clearly is the contribution from the Medicaid expansions under the Affordable Care Act and the non-group or exchange enrollment on a year-over-year basis. We're basically back to 2013 levels or pre-ACA levels at this point in terms of growth, with a lot of cost shifting occurring on the margin going forward. So we think, from here, healthcare moves really slowly. It's going to mean revert to this kind of curve where we're looking at slow volume growth and pricing and mix shift away from higher margin commercial pay to lower margin government pay. One of the ways we track this on a month-to-month basis, another output is on healthcare employment. Healthcare employment went straight up to the right following the implementation of the Affordable Care Act. One of the ways we think about this chart, again, the narrative for us here is that you got a whole bunch of newly insured people, created a lot of demand at the facility level. Those facilities hired up. There is very little leverage in the healthcare delivery system, whereas you need, for every new person that walks in a doctor's office, goes to the hospital, you basically need a new body to take care of them in terms of healthcare employment. And so we see that slowing here, but again, we think there's a lot of downside from here as well. It's held up reasonably well after the epic climb, but from here again, some slowdown coming. Hospital employment, sort of a similar story, but worse. We're short HCA currently, and we've got all the other hospitals on the bench. That slowing materially and even more so than the healthcare employment market overall. We're going to bring this down into an individual name that reported this morning, Mednax, where we use this data set and look for short. So we've been short this thing for a little while. And essentially what we saw this morning was them missing everywhere. We think it's a flawed business strategy overall, but one of the things that really hurt them this morning, reporting below consensus numbers, below guidance numbers, and then guiding pretty poorly for Q1. They have a lot of issues going on with an acquisition that they were forced into, we believe, on the virtual radiology group, and then moving into radiology groups, generally speaking, on a practice brick and mortar size. We think they're going to do a lot better in these smaller practices, 1 to 10. It's a really pretty small part of the overall pie. One of the problems going forward for these guys is that the growth is slowing, and we saw that in the earnings print miss and the guidance being poor. So they're under pressure where they're showing 1.8% down in NICU volume days. We have a way to track that, again, a data narrative piece, and then using the healthcare employment numbers and some other derivatives in the insured medical population. We can see on the next slide our maternity tracker, again, going negative. This is independent data that we look at on a real-time basis, but when we roll it into our data forecast model, we use a combination of employment factors and the maternity tracker data to show us, these guys are going to be under pressure from a volume perspective. So on the next slide, seeing that the doc weighted model and the MD adjusted same unit volume number coming in really close to what we were expecting. And again, this is something we're going to track and sort of de-risk our short position. Down, pretty small today based on the miss, 5-6% as when we walked in here. But I think that these two charts are going to continue to slide negative and continue to drag that acquisition-led model lower. They put up pretty weak volume and weak price. Again, this has been an acquisition roll-up story where the more they acquire, the more they can raise those rates on those newly acquired practices. As it's hard to buy because everybody's looking for growth, and they're getting out competed by some of these other acquirers in the group. So as much as that slows down, you're going to see problems with their growth profile going forward. And what it's also forcing that is a much, much lower return on invested capital. So they're going to have to put more money to work on acquisitions at a higher multiple to support a weaker growth trend, which is going to exacerbate this chart growth at the cost of profitability. So, they bought VRAD. It looks like they were forced into us. they've bought a bunch of other stuff at a slower rate, so their return on invested capital is slowing from sort of mid-teens to high single digits, and we think that has a lot more downside. Meanwhile, the operating margin is slowing as well in the next slide. And that's it. I mean, we could go through a lot of other names on our position monitor if you want to take a look at that and have individual questions, but yeah.
Okay,
Time
great.
for Q&A.
Again, if you have any questions, please submit them on the QA box, and we'll try to get all of them. So first question here. What has driven healthcare to outperform so far this year?
Well, I think it started from a low place. Given the earnings season of Q3, it really was one of the worst I've seen, and that's sort of anecdotally for me, just watching the numbers of companies that missed, guided lower. It was ugly. So I think it probably got punished to a degree beyond what was baked in from a growth perspective into Q4. So we've had both the broader rally plus healthcare sort of outperforming, from a lower starting point. Year to date, I don't really understand the outperformance. It's been pretty modest. I think if you draw that time frame back a little bit, it's been underperforming. So maybe there's a short-term blip we're not going to really concern ourselves with. But yeah, I think it's either the basis that it started from Q3 or just some sort of sense that Affordable Care Act reform, commentary out of management at JP Morgan in January, being less worse, probably led to some of that.
All right, great. So there's a lot of questions here just asking top, long, shorts, catalysts, so we can probably kill a few birds with one stone here. So top, long, top, short idea.
Depends on your catalyst and the time we were just talking about this a little while ago. I'd say from I think Cerner looks really interesting on the short side. You can touch on that. And then the longs, we got
hard. Longs are much harder.
I think the environment's going to be weak and things have rallied, so it's much easier, in my view, to be short after the rally. Athena sort of sets up, looks like a long here. We've got a lot of questions about Exact Sciences. We're long that, but it's not a best idea. But it's an interesting opportunity for a short squeeze, I think, into the print, depending on the guidance. And but I'd say Cerner from a near-term catalyst perspective, and I really love the HTA short, just because I think it's totally misunderstood. Yeah.
And on the Cerner question, I think bookings are going to come in light. So the question was, do you think that, is it still one of your favorite shorts, and do you expect a miss on earnings this week? They report out to the close on Thursday. I think bookings are going to be light. They did take down top line, at the end of, in the Q3 guidance in October, they took down Q4. So they probably had some visibility when they gave that guidance, but the risk is definitely to the downside in terms of their own guidance that they gave. So is the short answer. Okay. How should I think about healthcare as a defensive industry?
I think in years past, it's gone through several phases of being defensive or not defensive. The Bristol Myers Squibb, the first time I ever did work on that name in 1998, 99. It was a widows and orphan stock as the PM who signed it to me. Just you collect the dividend and it's okay. Pharma stocks were on a rip. Pfizer bought Warner Lambert. The things were trading at 50 times. But we immediately we had just been through one of the great epic growth accelerations in the healthcare industry from 1991, 92 to 2002. Or at least we were cresting out. And since then, it's been, companies that used to grow 10% now grow 2 or 1 if they're lucky. So the defensiveness, I think, is things take a long time. If you want to be defensive over 3 months, that a company's not going to miss the quarter or the guidance that they gave you, that's probably a good bet relative to a retail stock. But if you look at the structural changes underneath healthcare, it is far more consumer driven. There's going to be a lot more price transparency. The mix shift is going to be deflationary, both from a margin perspective and a pricing perspective. This is not a defensive sector, and if anything, it looks highly cyclical if we just pull back the time frame that you want to look at something. So our bet is from between here and 2023, it's going to be a sector that finds intermediate term lows, maybe you can trade them up, but for the most part, you want to just be negative on.
Okay.
So I'd say defensiveness is duration based, but not at all for this group.
All right, great. Zika, what's the latest and any way to play it?
No, not at this point. The peak Zika impact was really news flow generated around the later part of 2015, early 15. We definitely see that in the maternity tracker, where, and we asked a couple of survey questions on different survey methodologies. It looks like it had an impact here in the short term, but we look at Google News or any other kind of immediate term tracker, it seems to have faded pretty much, but we'll see. I mean, it's wintertime, low point in the mosquito season. We'll see if it picks its head back up in the spring. But yeah, it's a concern amongst potentially pregnant women of that age, sort of the 25 to 35-year-old age cohort. It's a big deal.
Okay, great.
But Mednax would be the play, but at this point, no.
Yeah.
That seems to have already happened.
Thoughts on the health equity print? Yeah, I mean, it kind of played out as we were somewhat expecting it to. We added it to both the long and the short side.
Well, short for the print.
Of our bench. Yeah, framing it up as, we were running out the model. It was kind of clear that growth was going to slow in a material way, just given that they haven't, made any acquisitions, and the stock's up 60% since the election on the bull case that the Trump administration is going to come out and cause explosive or reacceleration in market growth for HSA adoption. So, growth slowed. The stock's trading at 35 times EBITDA, 12 times sales. Upside is really hard to come by. It's really hard to see upside in that scenario, and when growth is slowing. So I think that's kind of the dynamic that we're seeing. So yes, the fundamentals are really positive, but it's probably not going to inflect to the upside until at least Q3. So that's kind of our initial takeaways on that one. Do you cover any of the veterinary names and any thoughts there?
No, not anymore. I mean, vet consumption looks very tightly correlated to vet employment, and the vet personal consumption expenditure 2 monthly data series that we track, and it's been reasonably strong. It really didn't fade away at this point. It actually showed a little bit of an uptick off the September lows. So yeah, we haven't really been involved either with Patterson or Shine for a while, or Wolf.
Okay.
I mean, not from the perspective of, is there a long or a short thesis to be had? We didn't have the M&A takeout thesis, so we're not going to step in front of something we're not totally sure on. But it's if we ever got super negative on the discretionary end of healthcare, particularly something like pet is fairly discretionary.
Okay. What's the upside risk to HCA from here?
I don't know. I mean, low 80s. It's got a 7 handle on the EV to EBITDA multiple. I know people are.
What's it trading on a PE basis?
That's I know. Well, question. I mean, I think that's the risk. I mean, I think it's the risk that somebody says to themselves, or enough people say to themselves, like, "Gee, I'm not going to pay attention to $30 billion in debt and a 50% debt to total cap. I'm not going to pay attention to 1.5% same-store adjusted admissions growth, and I'm going to agree that they're going to grow 2 to 3% as the management tells me. I'm going to assume that they can get margin, given that 2 to 3%, if anything, is all going to come in 5% margin Medicare business. I'm going to assume that whatever Trump does on the ACA repeal and replace and now repair is going to be positive somehow, even though there's absolutely nothing that's been said that could be positive. And then I'm going to assume too that their increase in capital spending from $2.7 billion to $2.9 billion isn't defensive, because boy, it looks like their relative capital invested in their in-market peers looks below. So is that catch-up? So will there be a cash flow crunch? Will there be some sort of issue here that presses margins, which we think will be mixed, and a volume slowdown generally? And will employers suddenly reverse the trend in high deductible health plans and copay and deductible increases that generally reduce consumption? And will managed care payers find some way to skinny networks or direct traffic to low-cost providers, which I don't think HCA necessarily is. I mean, it seems like there's a whole litany of negatives that we've identified around this name beyond a really well-managed company with really nice people who run it. It's just a question of, is it a sustainable model?
Yeah, I mean, you can only cut costs for
Yeah, I mean, they've already.
So long.
I mean, that's the thing is they've already done a great job cutting costs.
Which is why their capex is now going up.
Well,
they have to,
that's
I mean, eventually,
that's the alternative hypothesis in that
Yeah.
scenario.
Okay. This is another question we were asking ourselves earlier. Well, why do you think MDD is only down 5% on such a bad miss?
Well, if the story works out the way, I mean, I think the game here is really how do you when does everybody else agree with you, and are you wrong? Or sort of the dynamic, the push and pull on figuring out to be long or short of stock. And with MD, they've had so many problems over the last 12 months that it can only get better. And it's really easy, should you believe their narrative, that it is going to get better. Mm-hmm. And you can see, okay, EBITDA growth should grow, revenue should re-accelerate, and the multiple at 10 times whatever it is should re-expand to wherever it was. I think the key problem with that, and we've got some tools to track that, is that maternity is still down, JOLTS is just decelerating, so same store anesthesia should be under pressure, as should radiology, which they're hiring into, demand, which I think is going to fade. They're already admitting that managing headcount versus demand on the reading side, on the radiology, is tough. Mm-hmm. But let's believe them. Let's believe that their growth is going to be so secure that they can continue to acquire. Even though their pipeline has been full for 3 years and the pace of acquisitions has been slow. Again, what do you want to believe about tomorrow, and where's the directionality going? I think it's an easy comp. That's about all you can say for it.
Yeah.
But why isn't it down more? I have no idea. I guess because people believe that it's going to get better.
Yeah. Okay. Let's see. Athena outlook still good, just delayed near term only. Yeah, I mean, look, Q4 was a surprise. We didn't have a handle on it. Management didn't have a handle on it. They attributed the 4Q sales miss to a slowdown in utilization. Looking at it more closely, it's like, yeah, you saw the claims per provider number was down 2% year over year, where it's usually up 2% sequentially. So,
but you're going to dig back in on that.
Absolutely,
and figure that out.
yeah. I mean, I'm kind of hating I'm mad at myself because we have metrics related to outpatient utilization, PCE, that we should have had a better handle on it. At least tracking those metrics a little bit closely. But we're going to be laser focused. I hate saying that word, laser focused. To track this heading into Q1, and we'll continue to look at our own proprietary data sets. We need to see hospitals continue to accelerate. Sell side's already at the low end of their guidance, or management's guidance range for 17.
Yeah, so in terms of what's baked in to the estimates.
Yeah, and at 110, it's trading at 10 times, our 18 EBITDA estimates. And,
which is what Mednax.
Which is what Mednax trades at.
Right, which is phenomenal.
Which is really phenomenal.
For a hopeful 1 to 3%,
versus a
same unit
20% and 30% EBITDA growth.
Right.
I mean, it's actually, yeah, you put it in that context,
right.
And it is phenomenal. Okay. I heard a lot about millennials and them waiting on having children. Thoughts on this and the impact?
Yeah, we had a great time being long Mednax in sort of 09, 10 through to like 11, and part of the thesis was that births were way down too much, and the demographics were growing sort of 3% or so. That age cohort between 25 and 34. Clearly is continuing to grow and clearly doesn't make any difference over the last 3 years. So we had a nice little bump in like 2012 in births, and it's been pretty weak since. I think you could really just bounce up a bunch of reasons why births are slow, and sort of do your armchair economic analysis, interview your friends, and really not come to a clear conclusion about something that's a very long-term decision-making process. So yeah, I mean, kids living at home longer, starting households later, student debt, cost of home ownership. There are a lot of reasons that are probably very structural at this point in time, that are probably going to stick with us for a long time. So it may just be that women will age out and not have kids because the clock is ticking, literally speaking, as women get older from that age cohort. I mean, we're talking about almost 10 years ago that we saw a slowdown, and really, we're probably looking at a 1.5 to 2 million births that have not occurred, that are sort of, in the sidelines to some extent, and have yet to come back. That number just grows every year.
Okay. Sticking with demographics, what's the outlook for long-term care facilities?
No, I don't know.
Rehab? Okay.
Yeah, I don't know. I mean, it's really hard because they make so much money that you often, providers, generally speaking, I think are really good at pulling down incremental reimbursement, especially when there's a high margin associated with it. So long-term care has been in the eye, the target, the time, of Medicare to reduce spending for a while. Sure, long-term care is going to be highly levered to growth rates of people in their sort of 70s and 80s, which is a good demographic to be associated with, but I wouldn't want to be tied to anything to do with Medicare exclusively, because the federal government is going to come for this dollar at some point. Medicare has been extremely aggressive over the last 3 to 5 years compared to what they were through the 80s and 90s and 2000s. Spending per capita is coming down, and I wouldn't want to be on the other side of that margin, margin compression.
All right, great. What are your thoughts on Tom Price, and how do you think he will affect healthcare going forward? And then we can also throw into that thoughts on the Trump administration pressuring costs on Big Pharma.
Yeah, I don't know much about either. I mean, I saw the committee hearings on Tom Price. I mean, clearly he's going to be a little bit gentler, letting doctors practice and not interfering as much, but that doesn't mean that he's not going to be as aggressive on reducing that per capita spend. And then on Trump, I mean, I think the fade on ACA repeal and replace is pretty much in place at this point. So again, incrementally, I think it's going to slow anyway, and any reforms were going to be negative. So Trump said, now for ACA reform, which Tom Price will be playing a role in, it's happening sometime late 17, early 18. Are they real on this thing, or is now tax reform the bigger piece of, any kind of positive S&P 500, including healthcare reforms that get, that take place? We'll see. I don't think we know enough at this point to really have a conclusion about it one way or the other.
Okay, great. Thoughts on the U.S. medical economy and 3D growth and how it affects Hologic? I guess like the diagnostics business.
Yeah, sure. I mean, I think the interesting headwinds that showed up in this last quarter, their fiscal Q1, was that cytology slowed. They had problems in skeletal health. They claim that they took their eye off the ball from a management perspective, and maybe that'll come back. We do see that MQSA data, that's the 3D placements in the United States, was down sequentially Q3 to Q4, even though it's supposed to be at the early part of the growth phase, which I don't agree with. And yeah, it could be a material negative. I mean, I think Steris blew up this morning. It's a CapEx play in healthcare. We'll see how that goes. I think it's a nice tailwind to our short thesis, but it's not critical. And when we look at the bigger numbers like private fixed investment in healthcare, which is a census data number that comes out, I think on a quarterly basis, that is looks very high and ready to collapse at this point. Particularly if underlying demand at the facility level slows, they're going to look for places to cut. They're going to cut CapEx.
Okay, great. And we'll end on a process question. How does the current macro outlook feed into your investment process? And maybe you could frame that up in terms of our own healthcare outlook, and then maybe Keith's and the macro team's broader process. I
think it's a recipe for healthcare underperformance, because the macro for healthcare has been so wildly positive, like generationally positive, 14, 15, and 16, and it's going to be generationally weak relative to everything else that's accelerating. So I think healthcare is for sale. I think it's going to be a great time to be short. And on the margin, it might provide a little bit of a support framework, but you really have to grow non-farm payrolls like 5-6% to make a difference, I think, for healthcare, because we're only growing them 1 to 2% net of any kind of cost-shifting headwind. It could easily eat that up and then some. And then the demographics of the Medicare population growing, sort of steadily here at around 2%, and it's uninteresting to anybody involved in this space from a commercial perspective, because Medicare doesn't pay. I mean,
Yeah.
Hospitals tell us that margin on Medicare business is around 5%, lower for Medicare Advantage, and those two things are the only things that are growing in healthcare.
Okay, great. Well, thanks everyone for joining us, and thanks Tom, and everyone tune in next week for Jonathan Castling, who's the co-sector head of financials in next week's Sector Spotlight. Have a good day out there.